continuing on, within the judicial branch and pertaining to federal tax authority, there is the tax court, which you saw in the previous chart. So the tax court is a court that can issue either regular decisions or something that we call memorandum decisions. So regular decisions function like decisions in other courts, in other statutory areas. For the tax court specifically, these regular decisions establish precedent on either a new tax matter or a previously settled tax matter that now has a different set of facts and circumstances. So this is your cookie cutter, court decision. The tax court memorandum is a subdued version of a official decision, and it's essentially a report of a tax court decision, but generally we see this as having like minimal value in its precedent setting efficacy, because and especially because the issue itself has been decided at least once before, if not multiple times before. So the U.S. Supreme Court is the highest court in the land, and its function is actually pretty unique because it has something called discretionary authority. So the word discretion is easy to understand. It boils down to the Supreme Court having the choice of whether or not to review decisions of the courts that sit under it. And so when the Supreme Court, let's say, decides to hear a particular case, they will essentially issue a writ of certiorari, and we call this the Supreme Court's certiorari jurisdiction, which also is just a synonym term for its discretionary authority. So what will happen is, let's say you're representing a client and you're disputing a tax decision made by the IRS. You file a claim in the lower district court. You might not get a judgment in that lower district court that you're satisfied with, so you move on. You go to the U.S. Court of Appeals. You don't like that decision either. You would file something called a petition for a writ of certiorari, and once the Supreme Court gets that petition, they will review all of the contents of the petition, and it can choose to either deny it or accept it. If it denies it, then that denial does not express any opinion on the merits of the underlying claim. And the prior ruling of the lower court where this petition for a writ of certiorari is coming from would still stand. So if the Supreme Court decides to hear a case and issues a writ of certiorari, and they determine that the tax issue in question was decided by the lower court in an inconsistent manner, then the Supreme Court can actually pronounce its own decision and resolve the contradiction that exists there. So, now that we have a good understanding of the overall federal tax authoritative hierarchy, we now move on to the second section of this lecture, which is federal tax procedures. So, I will be covering this relatively briefly, and I'll only be focusing on filing requirements and claiming refunds. But just know that of these 4 bullet points listed as processes for federal tax procedures, that these are determinations and movements that either the IRS does or a financial professional does on behalf of a business or individual when engaging with the IRS. So the determination of a need to file a tax return is usually done on the financial professional end. The collecting tax through estimated payments is calculated on the financial professional end, but then enforced by the IRS. The refund claim of taxes paid is likewise the same thing, where the financial professional analyzes what are the taxes paid, what is an estimation of the refund that should be afforded to his or her client, and then the federal government does likewise, and then that refund is then paid back to the individual or the business. And then in terms of a deficiency in payment, it's the government or the IRS in this case that would assess and collect that deficiency, but it's the job of the financial professional to do so as well in order to provide the best financial advice and financial services. So the filing requirements for federal taxes for an individual is the federal income tax return. I'm sure a lot of you are familiar with the federal income tax return. You may have to file them as well, whether on your own or through your own financial professional. But a lot of people don't necessarily know that an individual only has to file a federal income tax return if their gross income is above a certain threshold, their net earnings are from self-employment are $400 or more, or he or she is a dependent, which is a person listed on another person's tax return. So in contrast to individuals, corporations must file an income tax return regardless of their gross income. You don't have to memorize this. I just included these first two bullet points in order for you to understand what are the basic filing requirements for federal income tax returns. What you should keep in your mind as very important is that a financial professional, once he or she is hired by a client, whether it be an individual or business, to take care of their taxes, then that financial professional is obligated to keep books of account or records that are sufficient to establish the amount of gross income, deductions, credit, or other matters required to substantiate any tax or information return must be kept. So these records must be maintained for as long as the contents may be material in administration of any internal revenue law. So employers in this country are required to keep records on their employment tax payments until at least 4 years after the due date of the return or the payment of the tax, whichever is later. As for a claim for refund, a claim for a refund of federal income tax that was overpaid for the current tax year is made by filing a return form 1040. If the refund claim is for a prior year, then the financial professional will file an amended return, which is the form 1040X. Form 843 is used to claim refunds of other taxes that are not federal income tax that was overpaid. So what's very important is a claim for a refund has to be made within the statute of limitations period for refunds. So the statute of limitations refers to the time period in which a claim may be filed. So if a claim is filed beyond the statute of limitations period, then that claim is void and is actually unable to be filed. So, in general, most refund claims must be filed by the later of 3 years from the due date or 2 years after the tax was paid.